we stopped yesterday. Yes, so before we start, if you have any question about last session or any other issue, please let me know. Yes, please, any question? And can you hear me as well? Am I audible? Let me know if my voice is clear or not by responding. Otherwise, I don't know what would be happening on the other side. Okay, thank you. Thank you very much. As you know that last time we started chapter number 10, which is about plant asset, natural resources, and intangible assets. We already started this chapter and we were solving questions up to depreciation, and we stopped at this one, units of activity method. And if you remember in the example which we were discussing, this is this is the example we were discussing last time, that a truck was purchased on January 1, 2017. The cost is 13,000. Salvage value is 1,000. Useful life is 5 years, and useful life in terms of miles is 100,000 miles. So now we already solved it under straight line depreciation method. This one we already solved it. Any question? In straight line method, is there any question you would like to ask me, or everything is clear? Now we will move to unit of activity method. Now under unit of activity method, what we are doing is we are saying that useful life is expressed not in terms of time, in terms of total unit of production or whatever which we expect from that asset. In this case, we expect that this asset, in this case it is a truck, it has a useful life of 100 miles. Now, why we need this one? Normally, manufacturing companies, right? Sometimes you can measure, you can say that production in terms of machine hours, right? So manufacturing companies, they can measure production in units of output or in machine hours or in miles, could be anything, right? So that's why this type of method is used for those assets whose life can be measured in terms of activity. Okay. Now this method we don't use it for building normally, right? For building or for let's say furniture, we don't use it. This method normally you use it for cars, equipment, machines, or airplanes. Okay. So that's why what we need under this method, the first thing you need is what is the total unit of activity. Now, what is the total unit of activity? This is what we are going to do. Okay, and rest the method is same. So first you have depreciable cost, and again another method you use it is sometimes we call it a unit of production method as well. It is same thing. And you have to remember another important concept. I'll show you one from the previous example schedule, a book value concept. Book value, remember, is always stop at a salvage value. You know, the last year salvage value should be same as a book value. We have looked at it in the last session as well. Right? So book value should be same as salvage value. Now, how we do it? So that is an important concept. I'll just show you. It's not showing in this list. If you remember this example, right, straight line, a book value in 2021. What is the book value in 2021? Is 1000, which is, what is the book value in 2021? Yes, Faris Adil, are you there? Faris Adil Asiri.
Yes,
Yes, Faris, what is the book value for year 2021?
it's the selfish price.
Yes. Now understand, yes, is actually I just need an attention from some students. That's why I ask question. So book value is 1000 for 2021. So understand the concept, because we are going to use this concept in next method. Book value cannot be less than the salvage value. You cannot depreciate an asset more than its salvage value. Okay. So just remember this concept. Also for theory types of questions, you will see this information there as well. So that's why it is an important concept which we need to remember, that the salvage value cannot be less than the book value. It should be same. So under unit of activity method, just a minute, I'll share a slide. So what we are doing in unit of activity method, first, based on that given data, 100,000 miles, depreciable cost is 12,000. We know, you know how to calculate our depreciable cost, right? Which was cost 13,000 minus salvage value. That's how you get this number. You calculated a depreciable cost per unit is 0.12, and unit of activity during the year is 15,000. So you get annual depreciation. Now let's say this is given. What is the mile driven in first year? In 2017, 15,000. So cost per unit is, we already calculated, which is 0.12. Annual depreciation, multiply this, you get 1,800. Total depreciation same. Book value is cost, which is 13,000, minus accumulated depreciation 11,200. Is it clear? The first row here, entries are clear. Okay, thank you. Ali Ahmed Al Shahri. Yes, Ali, are you there? Ali Ahmed. Yes, Ali, what is the entry of 2017? What will be debit? What will be credit? Let's say now is end of year 2017 and you have to make an adjusting entry. What will be the entry? Yes, Ali, what is the entry? Yes, Ali Ahmed, what is the entry? What is debit? You know it or you don't know it? Just give me an answer. Yes, Ali, I hope you are listening to me. Faisal Abdul Aziz. Faisal Abdul Aziz, are you there? Yes, Faisal. Okay, up to you. So I have to remove you. Yes, Mansoor, thank you. Expense credit, which expense? You should try to learn. There is an answer there by Mansoor Abdullah. Thank you, Mansoor. You need to practice. Ali Ahmed, if you don't know what is the entry, then it should be always, entry when I ask a question, it should be account as well as the number, right? The exact answer, it should be depreciation expense debit with 1,800 and accumulated depreciation should be credit with 1,800. This is how you prepare an entry. Again, all of those who are listening, accounting is not just attending a lecture on and watching the video. You will not learn. In exam, you will see different type of questions. Until and unless you don't have practice, it will be a difficult course. So you have to practice. Without solving, you need to have your handbooks, also sorry, your notebooks, right? So try solving. Whenever I ask question, try to solve it on your notebook. Now 2018 in unit of activity method. Okay, this is the entry you see here in the bottom. Same. 2018 is 30,000. Is the miles driven? This is given in the question. Cost per unit we already calculated. So annual depreciation is 3,600. So total depreciation or accumulated depreciation becomes 3,600 plus 1,800 is 5,400. Book value will be 13,000 minus 5,400, and then we continue like this one until last year. And again, as you can see, in last year the depreciation is annually 1,200, and a book value is 13,000 minus 12,000, it becomes same 1,000. So book value and salvage value are same. Is it clear? Okay, thank you. Okay, once we are done with unit of activity method, remember we are three methods. One was straight line, second was unit of activity method. Now this is the third method, which we call it declining balance method. Under declining balance method, we are also calculating our depreciation as well, right? But under this method, it says that there are some assets whose value is or whose utility or benefits in the beginning of year are more as compared to the coming years, right? Now here in this method, you have a high depreciation in 2017, then less in 2018, then 2019 is like this one, right? So you have a decreasing annual depreciation expense. Under unit of activity method, if you look at I'll show you. If you look at see the annual depreciation expense 1,800, 3,600, 2,400, it is changing, and it depends or it varies. It depends on the miles driven or activity which is your base. If you look at a straight line method like in the previous slide, I'll just show you. Under straight line method, if you look at annual depreciation like in this one here, you can see here that annual depreciation 2,400 is same. Understand the difference between three methods. In first method, it is annual depreciation every year is same. In unit of activity method, like in this slide, it is not same. It is changing. It varies. Okay, now declining balance method, or sometimes we call it accelerated method. We have decreasing annual depreciation expense over the asset useful life. Why we call it declining or double declining balance method, right? Because our book value is decreasing, right? Now you calculate the annual depreciation expense. How do we calculate it? What we will do is we will take a book value. Remember, we'll take a book value. So what do we have now? For example, I'll show you. First, you have book value at the beginning of a year. In this case, our cost multiplied by declining balance rate, or we call it double declining balance rate, which is 2 times our straight line method. What is a straight line rate or method? It is 1 our useful life, 1 divided by 5 in our case. So double declining, say 2 times 1 over 5 or 2 over 5, 2 divided by the useful life, you get a rate. This is what you call it, double declining balance rate. Is it clear? If you look at here, and I have to go back just to show you. Straight line method. See, the rate was 20%, which was 1/5. Under double declining, it becomes double. Is it clear? Why we have a 40% in double declining balance method in this slide? Yes. Is it clear why we have 40%? Yes, please. Okay. So now how we calculate? So what is the beginning book value? That's how you start. So because first year book value is same as what will be the book value in the beginning of year? Can you tell me? What should be the beginning book value in 2017? Yes, which is same as cost. Thank you, Abdulaziz. So beginning book value will be 13,000. Rate is 40%. So annual depreciation will become 5,200. Is it clear? Then accumulated depreciation, since it's a 1 year, only the same amount. Book value 13,000 minus 5,200 is it clear? Okay. And then the entry for first year for 2017, same, always depreciation entries. Yes, Abdullah. Is it clear how we get the rate? 2 divided by the useful life. That's how you get the rate. Two is fixed always, remember, and then it is divided by the useful life of the asset, whatever it is in the question. In this question, it is 5 years. So you may have 10 years, you may have 20 years. So it depends on the life of the asset. So the rate is not fixed. But under declining balance method, 2 is fixed. 2 divided by the useful life. Is it clear? And then how do we calculate a book value? Under declining balance method, you have to take it from the book value minus accumulated depreciation. Let's say for 2018, our starting book value will be same, which we 7,800. The last item in the first row, same item. Is it clear? The beginning book value of 2018, 7,800. Is it clear? Then you multiply it with 40%. Annual depreciation is, what will be the book value in 2018? Abdullah Ma'ana. What will be the book value in 2018? Yes, Abdullah. The book value in 2018. So 13,000 minus 8,320. So this is how it will be. Okay. cost minus accumulated depreciation. That's how you calculate a book value. Cost in this question is 13,000. Now book value in 2019. From where did we get this number? From last year, 2018 book value. And then you continue. Yes, is it clear until this point? Okay. Now what will be, understand, I'm going to ask a question. What will be the book value in 2021? In 2021, rather I should say, what should be the book value? Can someone tell me what should be the book value? Anyone, please. 13,000 minus, yes, what will be if you say 13,000 minus 1685? Yes, Faris, yes, it is correct. Abdullah, 13,000 minus 1685, no, it's not correct. Yes, yes, good. How we get it? Look at the comment. Yes, it should be like this one. Yes, everyone, please pay attention. 13,000 minus accumulated depreciation should be 1,000. We don't know that salvage value should be same as book value. Is it clear? Look at my comment here. But if we calculate, let's say if you calculate, yeah, Abdul, if I calculate annual depreciation for 2021, if you have a calculator, right, if you multiply what the number you will get, annual depreciation expense 674, right? Yes, thank you. So 674, thank you. So what will be accumulated depreciation? I need your calculators. What will be accumulated depreciation in 2021, which is 11,315 plus 674? Jabir Haza, can you calculate? 11,989. So minus 13,000. This should be our book value. Can you calculate? What will be the book value? Yes, brother. Thank you. Thank you very much. 8,989. Is it? 13 minus, brother, you have your calculator. Haza. Yes, thank you. Yes, brother. Why you have this number? 8,989. Yes, brother. Can you make a correction?
Yeah, doctor. I calculate something else. Sorry.
Okay. Yes. Jabir, what is your book value? Jabir Al-Dosri. Yes, thank you. Now see, yes, as per the accounting rule, we said that this book value should be 1000, especially in the last year, remember. Okay, but you are getting something other than 1000, so what you need to do is you have to make an adjustment in last year. So we will not write our depreciation as 674, but we will write it something else. It should be 685, right? Our annual depreciation in 2021 should not, we don't multiply with 40%. You don't have to write that number. You have to make an adjustment and you will write it 685 because then you will get book value same. Okay, so this is what we will make. See here, the number is 685. Look at the explanation in the bottom. Computation of 674, which is this, it is adjusted to 685. Why we adjust it? Because we want our book value to be 1000. Just mathematical adjustment. So now you calculate your annual and accumulated depreciation will become 12,000. So book value is 1000. Is it clear? Okay. So this is the case which you will always find in double declining balance method. Always it will be different. Luckily you may find it same, but always in last year it will be a different amount. Okay, so you have to make an adjustment. How to make an adjustment? It should be just mathematical adjustment. Is it clear now? Now if you look at annual depreciation, in first year 2017 is 5,200, 2018 3,100, so depreciation is decreasing. This is the reason we call it declining balance method, right? If you look at a book value, it is keep on decreasing. Annual depreciation expense is decreasing. So you have a higher depreciation in the beginning of the year, right? This is why we call it a declining balance method. Yes, is it clear? Okay, so as we can see that declining balance method is basically is we can say that it is compatible with our expense recognition principle because it matches higher depreciation expense in early years because there are higher benefits to be received from these assets, right? Because asset contribution will become less in later years, right? So we are saying that these assets, they're useful, they're some assets because their usefulness is higher in the beginning year, then it becomes less. So that's why we have this method. Okay, is it clear? So let's compare these three methods. Okay, this is for a partial year. We already know how to calculate for a partial year. That if you purchase an asset instead of January 1, we purchase it in April 1, then only 9 years are applied, right? And you have to plug in for last year to make a depreciation or total depreciation as 12,000. 180 is just a plug-in. Plug-in means just a number which gives us a book value of 1,000. Just try to practice. For partial year, the plug number 180 in the last year. Whatever is the balance left, you have to apply. Okay, I recommend you to solve this question by yourself as a practice to calculate these things. It's important. Partial year, try to practice by yourself. Is it clear? By partial year means that the asset was purchased not in the beginning of a year, during the year. Let's say in this case it was purchased in April, means 3 months have passed. So in April 2022, the depreciation of this asset will be completed. So what should be the annual depreciation in 2022? It all depends on our salvage value and accumulated depreciation, because we want our book value to be 1000. So these are the three methods as a comparison. You can see straight line. This is the annual depreciation which you have to record under each method. Straight line same, unit of activity method depreciation varies. Declining balance method depreciation is higher in the beginning, but the total depreciation is same. Sorry, so total depreciation over the useful life of the asset remains the same. Now, which method is acceptable in accounting? Each method is acceptable. Remember, in accounting, which method you should choose, right? Because it provides depreciation in rational and systematic manner, right? So all three methods are acceptable. Okay, but it depends on the type of assets. Which asset? Like for building, we normally use straight line method. For machines, unit of activity method. If you have an asset which have a highest productivity in the beginning year, then you use declining balance method. Is it clear now? Then for income taxes. Now, what do we mean by income tax? Do you know what is written on top? IRS. Anyone has an idea what is IRS? Yes, please. Anyone? You will see this term in many. Yes, organization in US. Yes, thank you. Which collect the tax, right? I will just write it here in. Okay, if you can see here, I say Internal Revenue Service. It is a government organization in US that collect the tax for the US government. Like in Saudi Arabia, what is the equivalent organization we have? You know the name of the organization here in Saudi Arabia? We call it Department of Zakah and Tax. Yes, Department of Zakah and Tax under Ministry of Commerce, right? It is same thing. I think we call it Hayat al-Zakah Dakhal. Am I right? Okay. So that's why in your books whenever you are studying accounting, finance, many courses, you will see this terminology IRS, right? So understand what does this mean. You'll see it in many courses, because our books are US based. So in US it is IRS. So IRS does not require taxpayer to use the same depreciation method on the tax return that is used in preparing financial statements. Now, sometimes I'll give you an example. Government may say, okay, if you use, for example, a machine which is made in Saudi Arabia, I'm just saying as an example, right? Then you have a less tax. Because remember, at the end there is a tax or zakat someone has to pay. Okay, so sometimes there is a tax exemption which is different. You know, your accounting calculation is different. The tax you give to government is different. Okay. Now this tax, sometimes they say, okay, you can use a different method. One method may be tax of the machine which is made in Saudi Arabia and you use in your business, you get some less tax, right? Or if you have a machine which is purchased from outside, you have to pay a high tax. I'm just making up one example, right? So you have different taxes, right? So that's why depreciation and income taxes are important, because the choice of depreciation method can change your depreciation as well. Now in US, taxpayers can use either a straight line method or some special method, right? We call it modified accelerated cost recovery system. You will learn it more detail about it some other courses, right? Not in this course, right? So but it is a depreciation method. We call it modified accelerated cost recovery method, right, for tax purposes, US. Okay, so the tax return or the tax report which you submit to the government, you may use some of it, right? So it is different, but this method is not acceptable for accounting under GAAP, which is generally accepted accounting principle. So MACRS, or modified accelerated cost recovery system, is not acceptable under accounting, but under government it is acceptable in US. Okay, this is just for your information. We will not have a calculation. Okay, now let's take a break, and after the break we will continue from this slide. Okay, any question? Okay, thank you. So please take a break.